Good morning, everyone. Today, we're delving into a critical economic discussion: inflation in Kenya. Are reduced levels true or false, and expected or unexpected? This presentation will offer an in depth analysis of President William Ruto's claims regarding Kenya's inflation rates from 2022 to 2025. As you can see, the headline numbers show a significant drop from 9.6% in 2022 down to 7.7% in 2023 and a projected 3.8% in 2025. But what do these figures truly mean for the average Kenyan? Let's explore the data behind these claims. President William Ruto has stated that Kenya's inflation, which peaked at 9.6% in 2022, has successfully decreased to 3.8% by May 2025. Our analysis confirms that this claim, based on official statistics from the Kenya National Bureau of Statistics and verified by Africa Check, is factually true. This timeline illustrates the journey, starting at 9.2% in September 2022 when the president took office, rising to a peak of 9.6% in October 2022, and then showing a consistent downward trend to 3.8% by May 2025. These are the headline figures that have been reported. To further solidify our understanding, let's look at the key data points and their verification. This slide reiterates the inflation rate fluctuations from September 2022 to May 2025, clearly showing the 9.6% peak in October 2022 and the 3.8% figure for May 2025. Our data verification, leveraging sources like the Kenya National Bureau of Statistics, Africa Check, the Central Bank of Kenya, and Trading Economics, confirms the president's claim about the reduction in the headline inflation rate from 9.6% in 2022 to 3.8% in May 2025 as factually accurate. Beyond the raw numbers, the trend itself is crucial. Kenya's inflation rate has indeed shown a consistent downward trajectory from 2022 to 2025. We can observe a significant 62% reduction from the peak of 9.6% in October 2022 to a trough of 3.6% in March 2025. The steepest decline occurred between September 2022 and September 2023, showing a 29% reduction in just 1 year. While 2025 shows some stabilization, the overall picture is one of declining headline inflation. This largely reflects the success of monetary policy actions. This reduction in inflation was, to a significant extent, an expected outcome of the Central Bank of Kenya's proactive monetary policy. The CBK has actively managed inflation pressures through various actions, notably interest rate adjustments. They cut the key rate for the sixth consecutive time to 9.75% in June 2025. With an additional reduction to 4.1% in July 2025. These actions helped guide inflation within the target range of 2.5% to 7.5%. The recent inflation figures of 3.8% in May 2025 and 4.1% in July 2025, falling within this target range, are strong indicators of successful policy implementation. From a monetary policy standpoint, this is a success story. However, while the official figures paint a picture of reduced inflation, a deeper look reveals a concerning counter-narrative. The low inflation rate may not solely be a sign of economic health, but also a symptom of deeper vulnerabilities. Firstly, we see evidence of suppressed consumer demand. This isn't due to genuine economic dynamism, but rather a significant decline in household spending, driven by shrinking disposable income. Secondly, the formal sector is shrinking. Over 130 companies exited or downsized in 2024, and formal job creation fell dramatically from 122,900 in 2023 to just 75,000 in 2024. A staggering 90% of new jobs are in the informal sector, offering limited stability. Compounding this are increased tax burdens, with new statutory deductions significantly diminishing take-home pay. The key insight here is crucial. Low inflation might be masking deeper economic challenges, not signaling genuine recovery. Let's dive deeper into the business environment that supports these vulnerabilities. The data on business closures is stark. Over 130 companies exited or downsized in 2024, and more than 9,400 businesses were deregistered between 2019 and 2023. This shrinking formal business sector strongly suggests economic contraction rather than growth. Simultaneously, job market trends reflect this downturn. While 122,900 formal jobs were created in 2023, this number dropped sharply to 75,000 in 2024. The overwhelming majority, 90% of new jobs, are now in the informal sector, which offers limited stability and social benefits. The business environment in Kenya shows concerning trends that challenge the narrative of sustainable economic growth. So, what does all this mean for the average Kenyan? The reality on the ground is that disposable income has declined significantly. New statutory deductions, such as contributions to the Social Health Insurance Fund and the Affordable Housing Levy, have further eroded take-home pay. The average monthly disposable income for a formerly employed middle-income earner fell from 41,000 Kenyan shillings in 2023 to 36,800 Kenyan shillings in 2024, a 0.7% decline. This is the inflation paradox in action. Despite lower headline inflation, essential goods remain expensive, and household purchasing power has been severely impacted by increased tax burdens. The price of maize flour, a staple food, rose by 18% between January and April 2025. Many Kenyans are facing economic hardship despite what the headline inflation numbers suggest. This brings us to a critical point: the disconnect between official statistics and the lived experience of ordinary Kenyans. While inflation has decreased to 3.8%, many Kenyans continue to face high prices for essential goods and eroding incomes. The average monthly disposable income decline, as we just saw, is a real-world example of this gap. Furthermore, essential goods remaining expensive and price increases for necessities offsetting inflation reductions contribute to a widespread perception gap. Quote, "Life remains expensive despite the official figures," end quote. This sentiment encapsulates the challenge. When income is shrinking and daily necessities are still costly, the benefits of lower inflation are not being felt by many households. In conclusion, President Ruto's claim about the reduction in headline inflation from 9.6% in 2022 to 3.8% in May 2025 is factually accurate. This decline is an expected outcome of the Central Bank of Kenya's proactive monetary policy and represents a significant improvement. However, the celebratory narrative surrounding this reduced inflation can be misleading. The low inflation masks suppressed consumer demand, a shrinking formal sector, and increased tax burdens. Over 130 companies exited or downsized. Over 9,400 businesses were deregistered, and formal job creation dramatically fell. Crucially, increased tax burdens have eroded household purchasing power. While the numerical claim holds true, the broader economic context reveals that many Kenyans continue to face economic hardship. Therefore, understanding the truth with context is paramount to truly assessing Kenya's economic situation.